Every day, I see another financial influencer telling you that billionaires never sell their stock. The viral advice claims the ultra wealthy just take out loans against their assets to fund their lavish lifestyles, paying zero in taxes, and then passing it all down tax-free when they die. The implicit advice here is that you should do exactly the same thing. You are told to open a margin account or a securities-backed line of credit to fund your life without ever triggering a capital gains tax. But this viral advice skips the absolute most important thing. It completely ignores the laws of financial gravity. Nobody ever asks where the interest payments come from. Today, I am going to break down the exact mechanics of how billionaires borrow against their portfolios. We are going to look at the real numbers, covering collateral, interest rates, margin calls, cash flow, and estate taxes. I am going to mathematically prove why attempting this billionaire cheat code as a retail investor usually results in total wealth destruction. Before we get into the brutal math of this trap, hitting that subscribe button is the highest return on investment for your time today if you want to protect your portfolio from terrible financial advice. Humans are evolutionarily wired to seek shortcuts. We love the idea of secret knowledge. The notion that there is a financial cheat code accessible only to the rich validates a societal narrative that the system is rigged against us, while simultaneously offering a very seductive, low-effort path to wealth. We also struggle to differentiate between paper wealth and actual liquidity. When headlines state a famous tech founder is worth $200 billion, people assume he just has billions sitting in a checking account. When they learn he doesn't, the borrowing narrative neatly fills that cognitive gap. This entire myth is largely a hangover from the zero interest rate phenomenon. From 2009 to 2021, borrowing costs were practically zero. In that specific macroeconomic anomaly, floating rate debt against appreciating assets did look like a risk-free perpetual motion machine. But we are no longer in that environment. The strategy is colloquially known as buy, borrow, die. The mechanics sound incredibly simple on paper. Step 1. You buy assets that appreciate in value, usually an index fund or individual stocks. Step 2. Instead of selling those assets when you need cash to buy a house or fund your lifestyle, you pledge them as collateral to a bank. The bank gives you a line of credit. Because you borrowed the money, it is not considered income by the IRS, which means you owe zero taxes on the cash you just received. Step 3. You hold the assets until you pass away. Your heirs inherit the portfolio with a stepped-up basis, meaning all those historical capital gains are wiped out for tax purposes, and the estate just pays off the loan balance. It sounds perfectly engineered, but billionaires do not possess magical ledgers. Debt always has to be serviced. The bank is not giving out free money. Let me show you exactly where the cash comes from to keep this machine running. Interest is paid via 3 strict mechanisms, and none of them involve magic. The first is portfolio yield. A massive portfolio generates organic liquidity through dividends and interest. The second is external business distributions. The ultra-wealthy usually have private real estate cash flow, private equity distributions, or massive salaries that cover their debt service. The third mechanism is strategic capital erosion, which means borrowing additional funds just to pay the interest on the original loan. I cannot stress this enough. Rolling the debt is a mathematical ticking time bomb unless the after-tax asset growth rate significantly exceeds your borrowing rate every single year. When you see a billionaire borrowing against their stock, they are almost always using the first 2 methods. They are using natural cash flow to service the debt. They are not borrowing more money just to pay the interest. But the retail investor, lured in by social media, almost always relies on the third method, which leads us to the mathematical trap that ruins portfolios. Let's run the actual numbers. If you think paying a 15% capital gains tax on your portfolio is an annoying hurdle, wait until you see the math on a forced institutional margin call. Most people focus entirely on the upside of dodging a one-time tax bill, while completely blinding themselves to the structural tail risk that can wipe out half their net worth in a single afternoon. When we break down the difference between how a billionaire executes this strategy and how a regular millionaire tries to execute this strategy, the disparity in risk is staggering. It all comes down to the loan-to-value ratio and the institutional pricing tier. The game is literally played with different numbers depending on how many zeros are in your account balance. So I have run the exact numbers for a 2026 interest rate environment, and I want to show you side by side why one strategy succeeds and the other bleeds cash. Let us look at the optimizer. We will assume a $1 billion portfolio. The billionaire wants a $20 million loan for a new jet and some general living expenses. First, notice the loan-to-value ratio. $20 million against a $1 billion portfolio is an incredibly low 2% loan-to-value. This is virtually zero risk to the bank. Because the collateral is so massive, the billionaire gets ultra-high net worth institutional pricing. Let us assume a secured overnight financing rate plus a tiny 0.5% margin. Their interest rate sits at a highly competitive 5.5%. The annual interest on that $20 million loan is $1.1 million. Now, where does the $1.1 million come from? Well, that $1 billion portfolio yields a very conservative 1.5% in natural dividends. That is $15 million a year in organic cash flow. The $1.1 million interest payment is seamlessly swallowed by the $15 million dividend stream. Their cash flow coverage ratio is 13.6 times. No assets are sold, no taxes are paid on the principal, and the portfolio keeps growing. Now look at the retail trap. An investor with a $1 million portfolio wants $200,000 for a house down payment or a lifestyle upgrade. That is a 20% loan to value. It is 10 times higher than the billionaire's risk ratio. Because they only have $1 million, they do not get institutional pricing. They get retail margin or standard line of credit rates. They might be paying the overnight rate plus 3.5 or 4%. Suddenly, their interest rate is sitting at roughly 9%. The annual interest on their $200,000 loan is $18,000. The $1 million portfolio yields the same 1.5% in dividends, which produces $15,000 in cash flow. Do you see the problem? The natural cash flow is $15,000, but the interest bill is $18,000. The retail investor is bleeding $3,000 a year in negative cash flow. To pay the shortfall, they either have to contribute income from their day job, or they have to sell assets to pay the interest. If they have to sell assets to pay the interest, they trigger the exact capital gains taxes they set up this whole complicated scheme to avoid. Plus, they are paying a 9% premium to the bank just for the privilege of doing so. Think about leverage as being like a nuclear reactor. It produces massive amounts of energy and wealth, but it requires a constant, highly pressurized stream of cooling water to prevent a total meltdown. That cooling water is cash flow. Billionaires have absolute oceans of cooling water. They have massive dividend yields and private business income. Retail investors trying to mimic this strategy are walking into a nuclear reactor with a garden hose. The math works perfectly fine when the market is up and rates are at zero. But when a drought comes, in the form of a market crash or an interest rate hike, the reactor melts down. You cannot build a 10-story antenna made of debt if you only have a 2-story foundation made of assets. A light breeze will topple the entire structure. Most people stop here and lose $50,000. They assume that even with negative cash flow, the overall stock market returns an average of 10% a year, so their portfolio will just naturally outpace the 9% loan over time. They think they can just roll the debt indefinitely. Here is the massive, irreversible step they miss. The true cost of this strategy gone wrong is not just the interest rate. It is the permanent loss of compounding. Managing floating rate debt against variable priced assets is institutional grade treasury management. But retail investors treat it like it is as passive as holding an index fund. The market does not go up in a straight line, and the bank does not care about your long-term average return. The bank only cares about the exact value of your collateral at 4 p.m. today. Let us talk about the tail risk and the margin call. If a retail investor takes out a 40% loan-to-value line of credit on a volatile, tech-heavy portfolio, they are walking on a tightrope. If a standard 30% market correction happens, their equity drops rapidly against a fixed debt load. This pushes them right up against the Regulation T maintenance requirement. The Federal Reserve sets these rules, and brokerages often have even stricter internal thresholds, usually requiring you to maintain 30 to 40% equity in the account. When you breach that line, the brokerage does not ask politely. They will forcibly liquidate your assets at the exact bottom of the market crash to cover the loan. You suffer the permanent loss of capital. If your portfolio loses 50% of its value, you need a 100% gain just to break even. But because the bank sold your shares at the bottom, you no longer own the shares needed to ride the recovery back up. Debt mathematically accelerates you toward this edge. Then we have the final piece of the puzzle, the so-called die part of the strategy. It assumes you can just hold these leveraged assets until death and pass them on tax-free. But in 2026, the Tax Cuts and Jobs Act sunsets. The estate tax exemption is slated to drop dramatically, from roughly $14 million down to about $7 million per individual. For wealthy, but not quite billionaire-level individuals, holding highly leveraged assets until death may suddenly trigger a massive 40% federal estate tax. This forces the estate to liquidate the portfolio anyway, just to pay the IRS. The entire premise of dying to avoid taxes falls apart if the estate has to conduct a fire sale to clear the debt and the tax bill simultaneously. The rules of the game change, and if you are locked into a massive debt structure when the tax code shifts, you are completely trapped. You need a system to manage this before you ever take out a loan. Understanding this math conceptually is one thing, but actually implementing it across your own accounts is where most people fail. I kept seeing viewers get overwhelmed trying to calculate their natural portfolio yields and cash flow coverage ratios in messy spreadsheets. That is exactly why I built the Cash Class web app. Cash Class is the official Tom Talks Money platform designed to be the bridge between learning the math on this channel and actually optimizing your own finances. And the best part is the privacy-first design. There are no risky bank logins required. You just upload your standard CSV statements directly to the web app, and it handles the categorization and cash flow tracking for you. It keeps your data completely isolated and secure. Plus, when you sign up, you get access to my free Budgeting 101 course built right into the dashboard. You can start your 14-day free trial right now by clicking the link at the very top of the description below. Just open the description, click the Cash Class link, and start managing your cash flow like an institution today. This is where conventional wisdom says to either avoid debt entirely or blindly trust the stock market to bail out your margin loan. I am going to give you a completely different approach. We are going to replace the viral buy, borrow, die myth with a highly systematic treasury management protocol. If you are a logic-driven investor wanting to optimize your wealth, you cannot rely on hope. You have to treat your personal finances like a corporate balance sheet. I have noticed that people treat credit lines like found money. The human brain actually processes available credit as income, leading to mental accounting bias. We end up borrowing against our future financial independence to buy depreciating assets like cars and vacations. To stop this, we need strict mathematical boundaries. I call this the Optimizer Protocol, and it starts with a hard cap on how much you can borrow. Protocol 1 is the loan-to-value hard cap rule. Never, under any circumstances, exceed a 15% loan-to-value ratio on a diversified equity portfolio. If you have $100,000 in investments, Your absolute maximum line of credit draw is $15,000. Why 15%? Because it builds a fortress around your assets. Even in a 2008-style market drawdown where equities drop by 50%, your revised loan-to-value ratio only reaches 30%. This keeps you mathematically safe from the standard 65 to 75% institutional liquidation triggers. You survive the crash without a forced sale. Remember the skyscraper foundation analogy. A massive foundation can easily support a small antenna, but if you try to max out your borrowing capacity to 40 or 50%, you are building an antenna heavier than the foundation itself. By capping your leverage at 15%, you eliminate the catastrophic tail risk of a margin call and ensure your compounding engine never gets shut off prematurely. Protocol 2 is the cash flow coverage ratio. The rule here is simple. Your organic portfolio yield must be greater than your total debt interest multiplied by 1.5. Before you borrow a single dollar against your portfolio, you must calculate the natural dividend and interest yield of your underlying assets. If the natural cash flow of the portfolio cannot pay the interest bill and still leave a 50% buffer left over, you simply do not borrow the money. You must never rely on capital appreciation to service your debt. Stocks going up is a bonus, not a payment plan. If you ignore this, you run straight into the reversed rule of 72. If you divide 72 by a 9% margin interest rate, you get 8. That means in just 8 years, the interest you owe will equal the entire amount you originally borrowed, completely cannibalizing your portfolio if left unchecked. A strict cash flow coverage ratio prevents this silent wealth destruction and forces you to respect the cost of capital. Protocol 3 is the arbitrage reality check. You need to calculate your net arbitrage spread. This is your expected post-tax asset return minus your after-tax borrowing cost. If you are paying 8.5% on a line of credit, your portfolio must guarantee a return significantly higher than 8.5% just to break even. Because equity returns are volatile and completely unguaranteed, borrowing at high retail interest rates simply to avoid a one-time 15% capital gains tax is mathematically irrational. It is essentially the tax shield mirage. Taking out an 8 or 9% floating rate loan to avoid a 15% capital gains tax is like stepping in front of a freight train just to avoid a bee sting. You traded a known, one-time, fixed financial friction for a compounding structural liability that scales over time. Often, when you run the true arbitrage numbers, it is genuinely cheaper and safer to just sell a small portion of the asset, pay the tax, and reallocate your capital cleanly. The fourth and final protocol is asset matching. This is the right way to borrow, and it is exactly how institutional wealth operates. Billionaires use equity margin for short-term bridge loans to solve immediate cash flow timing issues. They do not use it for 30-year structural debt. For long-term debt, they use fixed-rate real estate loans. The protocol dictates that you must match volatile assets like stocks with cash, and you match stable assets like real estate with fixed-rate long-term debt like a standard mortgage. You should never cross-contaminate volatile assets with floating-rate debt unless the duration is short and the exit strategy is mapped out in advance. When you match the stability of the asset to the predictability of the interest rate, you neutralize the sequence of returns risk. You stop fighting the current and start letting the math work in your favor. If you're the type of person who loves digging into the actual math behind these viral financial claims rather than just blindly following them, I invite you to click the join button below the video and become one of the optimizers. This is our channel membership community for viewers who want to take their financial literacy a step further. When you join, you get priority comment replies from me, meaning your questions get pushed to the top of the queue. You also get custom sketch badges next to your name in the comments to show how long you have been mastering these concepts alongside us. It is a great way to support the channel's research and ensure we can keep putting out this level of deep dive financial education. Click that join button and become an optimizer today. I would love to see you in there. Let us turn the comment section into a data gathering experiment. I want some peer review on this. Let me know down below if you have ever considered using a securities-backed line of credit, and what interest rate your brokerage is currently quoting you. I read through the comments to see how these rates are actually impacting retail investors in real time, and your data points help me build the models for future videos. Do not forget to check out the Cash Class web app via the link in the description to start getting your own cash flow mapped out securely without handing over your bank logins. Stop listening to people who tell you debt has no consequences. Keep your loan-to-value ratios incredibly low, demand a massive cash flow coverage buffer, and respect the math. Thanks for watching, and I will see you in the next breakdown.